How do we survive a housing affordability crisis? On this week's episode of MLO, Addie and Brie are going to break down these fine details to teach you how to succeed and know what to do in a housing affordability crisis.
That's a finger snapper. You've got the beats. I love when producer Josh just throws in super nice intro music for the show.
It's very nice. This has a little, kick drum.
Yeah, when I'm wanting to talk about mortgage, I wouldn't expect this song, but it really, it's peaceful and energizing at the same time.
Oh, a little saxophone on that one.
I love it. Everyone, welcome to the show. You are watching MLO. I am your host, Nett, and of course, this is the mother of mortgages, Brie Fisher. Brie, thanks for being with me today.
Hi, Addie. Hi, everybody. Great to be here.
I really like our topic today.
I do too.
Because I think we're integrating a lot of questions, right? A lot of questions we're getting right now.
Perfect for the new year.
New year.
Incomes change the beginning of the year.
Resolutions
are made. New goals are, the goals and resolutions are set of, what do we want this year to look like for our family and ourselves?
Yeah.
Great topic.
Yeah, and we want it to be a long-term impact, not like, I always remember when in high school, I had a part-time job working at a gym, and I remember January was always slammed. Because everyone would be like, I'm doing it every day. And then Feb 1 hits, it's like ghost town.
Yeah.
You're like, oh, hey, someone's coming through the door. And they're just picking up something they left there, oh, no, I'm not working out, No. Oh, my gosh.
I left my water bottle.
Yeah, lost and found, please. We are chatting about affordability specific to mortgages in the real estate industry and really breaking down kind of some variables. What are the details of the affordability factor? What can we get approved for? What are the different things within the mortgage process that set our monthly payment, right, Brie?
Right. And so much, even before prices have gone up so much in the last year, particularly in our region, that's always a question of what really can I afford? Because it's not just the housing payment, right? There's other factors involved when you buy a house or buy an investment property even, and what are those factors entail? So we're going to dive into that.
Yeah, and that's a good point. I'd also like to preface too, everyone has their different situations. So we're going to try to speak as generally as possible and touch base on the different variables that could make them different, whether that's interest rate or payment or where you live in the country or the state where we're working. Your credit score. And we are very respectful to the fact that everyone at home has a different situation, right, Brie? Because it's not a universal budget for everyone. Right. People have student loans or kids or no kids or more disposable income or even maybe commission. They work on commission and not salary, so their budget might swing all the time.
Yeah, and we always talk with our customers that it's about your personal budget, really. Your affordability, because as you were just saying, Addie, that, we can qualify you for a certain amount, but it's only going to be based off of the debts that are on your credit report. And we'll get into that a little bit, but we all have personal situations that change our affordability factor. Yep,
I totally agree. And I think the biggest thing we can start off as the opener is kind of the journey and the comparison from 2019 to 2020 and now 2021 on interest rates. That's the first thing we're going to start with. So just to give a couple of references, based on mortgageratekick.com, currently at the end of 2020, we're looking at about a national average on a 30-year conventional loan between 2.75 and 3.25. National average, a little bit of a big window there, but there's some factors, to your point earlier, the credit score, the down payment, what state you're in. Different states or different parts of the country might have slightly higher or lower interest rates, so we throw a range in there. But to reference the earlier parts of 2019, you're seeing really a 4 to 4.5% interest rate, right, Brie?
Absolutely. So, right in 2019, the first part of it, the end part of 20 and 18, the interest rates were a good point and a half in some cases, depending on the loan product, different than they are today. So just to kind of give you an example there, about a year ago, if the sales price of a home you're looking at was $450, and you put 10% down, so it's 45,000 down, your interest rate and monthly payment's going to be about $1,875 a month. Today, relatively, the house prices have gone up a little bit, and we'll talk about that here. But if you're buying a $500,000 house, so you've just increased your home affordability by $50,000 on the sales price, and you put the same 10% down, you're putting a little bit more, initially at that investment, $5,000 more, but the monthly payment is going to drop by $38 per month. So I'm buying $50,000 more in a sales price right now because the interest rates are 1 plus, 1.25%, 1.5% less, but my monthly payment's going to be less on a higher sales price.
That's very, very dramatic. And to add to your point, Brie, to do a flat line, because that was a great example of like, wow, I could get $50,000 more in house or a sales price budget and actually have a lower payment comparatively to the earlier parts of 2019. For a flat line example of, say, a $300,000 loan amount, the amount borrowed, not the sales price, just the mortgage amount, at 4.5% interest, the principal and interest on that is $1,520 for a 30-year mortgage, which is most traditional. So if interest rates have lowered in your scenario to the averages of around 3.25, that is $1,305, which is a $215 a month reduction.
Huge.
There's a lot of people who hum and haw over auto payments, other deals that are even higher than $200 a month. Like that is such a huge dramatic swing on the apples to apples comparison, wouldn't you say?
Absolutely. I mean, think about, that $200, what that can mean to you and as far as investing and other things you want to do, or, taking a vacation that, once we can come out of COVID here, traveling or investing or, investing in your retirement or things that the children need.
Yeah. $200 a month is, what's that?
Huge.
$2,400 a year. That's a lot. There's a lot of people fighting for that amount and an increase in their annual salary every year and not getting it. So there's a lot of people whose rent might increase every single year by $200+ and they're stuck in the renting game, right?
Or health insurance. If the health insurance costs
really
go
good
up,
example.
because every year health insurance, whether it's partially or fully employer paid or whether you're paying it entirely on your own, health insurance goes up every single year. So look at it as, now if we're refinancing or buying a house and have a lower interest rate, maybe we can afford, different health insurance.
Well, on a super more casual note, I'm pretty sure my Netflix just went up like $3 extra a month. I mean, I'm hardly keeping up with the Netflix appreciation.
And my Hulu, I think, went up 10 or something.
Oh, did you go no ads or?
I did go no ads.
It's worth it.
I did. A couple, it was like $6 difference. So I'm like, yep.
You got it back in time wasted though, watching ads.
Yeah, but that's like, your 11:30 p.m. to 12 at midnight TV.
Yeah, 100%. Well, and going into other variables, because this was one thing I didn't want it to just be in our pre-show brainstorming. We didn't want this to just be your normal, interest rates are down, you can afford more and your payments lower. But there are a lot of factors that really aren't covered in initial mortgage strategies or calls with people within our industry. And I think reviewing some controllables, because say you're a year out, say you're 6 months out, what can you do now to set yourself up for a lower monthly payment regardless of where the market conditions of interest rates go, right? Number one key, to your point at the intro, is your credit score. So the interest rate is heavily driven on a lot of different factors, the loan program, the down payment you have, but primarily the credit score, right, Brie?
Absolutely. Going from even a 679 credit score up to, a 720, that's, 41 points. It's really not that big of a difference, it can make anywhere from a quarter to some cases 0.5% difference, depending on the loan product, difference in interest rate. That's huge. And that could change your payment, from anywhere from $30 to almost $200 a month. Yep. A loan amount, of course, depends on that, but it's a huge difference of what your credit score is. And so, what do we do and how do we get that 40 extra points and what do people do?
Yeah, in most cases, too, with the credit, and we're not licensed credit advisors, which I don't even know if those exist, but I have to preface saying we're licensed mortgage advisors. That being said, a lot of it really has to do with the credit utilization ratio. So how much you're allotted to put on your trade lines or your credit limits and what those balances are. So you're going to reference our past episodes on the credit building and how those are all monitored. But a lot of the time it's simply because you might be at 50% utilization, meaning for easy math, you have a $1,000 credit limit. Say you're at $500 balance out at the end of the month, you've hit 50% of your allotted credit limit. And that actually is, in what I see most of the time, the scenario of why that score is anchored in that mid to high 600s, and getting that at 20% down or below, typically what I see is that gets you up to 700. And Brie, I ran a quote the other day just on the mortgage insurance for a conventional loan, which the monthly premium on that is heavily driven on the credit score. The swing ding on that was like 400 all the way down to, I think it was like 160 in this scenario. Wow. So there was more than, more than a $200 decrease in their monthly payment because of that small shift. And everyone gets so caught up on other non-controllables, on making the decision to buy or sell, stop renting. Like, when is it going to be a foreclosure market? What's going to happen with interest rates? Honestly, those are uncontrollables. Right. But what you can control is your credit, which has just as much of an impact decreasing your monthly payment, right, as the interest rate.
Yes, absolutely. And, we ran somebody recently, they were right at 679, and they had a couple accounts in dispute, and a few credit cards that were, higher balances, but something that they could have used part of their down payment because they had more in their down payment than what they really needed. Yeah. So use part of your down payment, pay that off, and we were able to do a rescore and get their credit past 720, and they saved a lot of money in their, monthly payment. So that's huge.
And that's the difference between working with a mortgage advisor and industry professionals within real estate that really care. Like, they're naturally going to sit down with you and analyze your scenario on a custom level. And I'll just be like, here you go. Like you're buying some car, right? This is like, oh, well, we could do a few things. We could drop, say, from 6% down to 5% down, use that money to pay down a little bit of debt, right? And improve that score. And then everything falls into a lower. So you get the current mortgage interest rates, that reduction, the better insurance premiums, and it all just funnels into a lower monthly payment. Right. I just think that's so big because a lot of I'm going back to those uncontrollables. So many people wait for an uncontrollable to happen, like that foreclosure. I hear that all the time. I'm waiting for it to be a foreclosure market because of the pandemic and this and that, or interest rates. And it's funny, like, back 10 years ago, people were okay with a 7 to 12% interest rate, but now in the low threes or sub threes, people are like, I think I'm going to wait. It's like, wait for what?
Right. I only want 2.7.
I mean, we live in America. At a certain point, different industries need to make money. So the interest rates won't be zero. Like, they will never be zero, not for the consumer. So I just think controlling something alleviates a lot of stress in the process, and that is something you can control on whether you own a house now or you're planning to, right?
Right. Get your credit score checked by a mortgage professional. So let's talk about that a little bit, because sometimes people come to us and say, hey, I know my credit score is great. It's 740 or whatever it may be. I check my credit on Free Credit Report, whatever online free monitoring agency that so many people are part of, which is very important to do that. It's fantastic to do for general monitoring of your credit.
Right, for estimates, yeah.
Yes, absolute estimates. But the majority of the time when a mortgage person pulls your credit report, it's going to be a different score than what those online monitoring systems show. And there's several reasons for that.
Sure.
The algorithms that we pull are different than what the online monitoring is. And they don't always necessarily rate all of your debts, not necessarily rate for more than the last few years. They might not go back. So when we pull it, it's going to be higher or lower than the score that you're used to seeing. And that's perfectly okay, but get a mortgage broker to pull your credit report and review that with you. because if you are, close or can be close within a few months of the next credit score level tier, so depending, on the loan product, it could be 680 or 700, 720 or 740. Depending on the next tier, could save you so much money, and sometimes it doesn't even take that much in paying off debt or rearranging, what balances you have on certain cards and this and that, or even removing yourself as an authorized user on accounts. That could be a really big impact to your financial affordability for long term. And then another part of that is I've gotten recently with, this year, a lot of this, all of the student loan payments, unless maybe they're in private, are on, forbearance.
Right.
Right. And so recently I had somebody ask, is that affecting my credit score? Is, my forbearance for not paying the student loans all year going to affect that? And it has not affected credit scores. However, we still have to calculate a student loan payment.
Right.
In that. So, we still have to calculate them either for what you're paying or a certain calculated percentage based off of the loan product of what your monthly student loan payment would be. But those have not affected credit score.
That's a good point. Yeah, good insight right there.
And then we have another something we get asked quite a lot is how many credit pulls can you do until it affects my credit, right? So I had, Joe Broker down the street pull mine yesterday, Brie. So I'm not sure if I should let you pull it. That's what we get, right? So here's the answer to this, is that the credit bureaus have algorithms that allow for 3 mortgage pulls in 90 days without affecting your credit negatively. So if you've had it pulled by one other mortgage person, you certainly can have it pulled again without a negative impact. Now, sometimes if there's been a few weeks between pulls and the credit, your debts have cycled with the credit bureaus, your score can be different. So if we've heard sometimes, hey, you pulled ours on December 1st and someone else pulled them November 1st and they were different, it could mean that within that few weeks, the balances on your credit cards were different. They were maybe more or less depending on what your new score is. So there are changes to that. But generally, you have 3 pulls and 90 days with the mortgage company before any impact to your credit score. Very different than if you had a consumer store credit, of course.
That's a really good point to somebody shopping, mortgage advisors, and maybe deciding who to work with, and they're close to buying or they're refinancing. That's a huge point. And I like that. That's been a lot of changes over the last 3 to 5 years with the Fair Credit Reporting Act and doing things to protect the consumer. Backing up really quick, I did want to touch note, because not a lot of people do know this. When you are looking at those estimators, often it's from not only just an estimate, not a hard pull, but it's from one of the 3 bureaus. So there's 3, TransUnion, Equifax, and Experian. So you might be looking at your TransUnion score, and there's different numbers for each bureau. In the mortgage world, on the hard pull, it does not an estimator, a hard pull from all 3, and your score for the file is the middle of the 3. So not the high, not the low, but the middle. And if you're applying with a spouse or a cosigner, you are the lower of the 2 middle scores. So only as strong as the weakest link on the chain, right? But I think I hear that all the time where people are like, they'll send me a screen grab. I'm like, oh, I'm a 715. And you can see right on there that it's an estimator from TransUnion. And yeah, their TransUnion was 715, but their Equifax was 680, and their Experian was 700. So their mortgage score is 700 in that situation. So that's one thing to know. It takes from all 3. You can take note on the estimators. Another point I put together, Brie, is people ask me all the time, because I deal with a lot of people relocating here. So they're talking to me anywhere from 12 to 6 months before they're making the move. And I give them the credit, walk through and the utilization and paying it down and doing the best you can and monitoring the estimates. But I'm typically wanting to pull credit with my clients up to about 90 days from when they're offering or wanting to close, so there's not a repull or whatnot. So that's something that I do specific to my clients and how I advise, because there's a lot of stuff you can do by using those estimators effectively and just simply paying down balance. And you don't need to spend a whole lot of your time calling 7 mortgage advisors when you're just trying to work on your credit. Utilization ratio is a huge factor on the controllable side, right, Brie?
Very much, very much.
Yeah.
Yes.
Transitioning, I think another shadowed piece, and it's hilarious that, to me, why not a lot of mortgage professionals or real estate professionals bring this up. One of the biggest factors to your monthly payments, property taxes. It has nothing to do with interest rates or your credit score.
No.
It's property taxes. There's a lot of variables to what that assess. So, Brie, I wanted to get your take on property tax. How do you talk to your clients about that variable difference?
So one of the first things I ask is, where are you buying? And I don't mean Oregon, Washington, Virginia. I mean, what neighborhood are you buying in?
Yeah,
because
like the county.
The county,
yeah.
And sometimes even just the neighborhood is different from one street to another, depending on what bonds have passed.
Right.
In California, they have a lot of bonds and they have Melrose and things in different neighborhoods, so that really affects from one neighborhood to another. But what I ask is, first, where are you buying? What school district are you buying in? What zip code? What neighborhood? Because that's going to make a huge difference. And to give an example, here in Portland, I had a couple recently who bought a house. It was $550,000, and their property taxes were just over $3,000 a year, pretty low. I have another couple within the same few weeks who bought a house at $425,000, and their taxes were $5,600. So you're talking over $100,000 less in sales price, but our taxes are $2,000 more per month. It's a big difference.
Yep.
And if you take that, the property taxes, we take the annual amount and divide it by 12, and that's your monthly part of the monthly qualifying for the mortgage payment for the property tax portion. So depending on if that's $5,000 a year, $10,000 a year, or $2,500 a year, will make a serious impact in your monthly affordability.
It's huge. I mean, we're bragging about interest rates dropping so much from 19 to 20 to 21 that it's impacting a $300,000 loan by $200 a month, when you could be looking at the same sales price for house A and B, but the other house has $200 more a month in property taxes. You just washed your savings. Right. So what are those factors? I always kind of explain it as like, hey, there's a lot of variables. To your point, the county is the biggest one. So certain counties assess them differently based on their tax structures, what's been voted on, to your point, but also lot size, the actual land, because there's some bigger lots, there's smaller lots. Here where we live, they take a lot of lots and they split them in half. So if you've got a full lot or a half lot, your taxes are going to be different accordingly. Year that the structure was built plays a huge role, because different counties will have different appreciation caps, meaning if something was built in 1940 and it's never been reassessed because, Grandma and Grandpa Wilson have been there forever, they might still be at a very low tax bracket. Comparatively, something that's been built in the last few years might be fully caught up to appreciation. So there's other different things that factor in that are somewhat of an uncontrollable. But the way you can turn that into a controllable is work with your mortgage advisor and verify those taxes, Brie, because there's so many times, and it's way less than it used to be, so many times that the internet is not necessarily giving you the most accurate information. It's gotten a lot better, we'll say that. Like 3 years ago, it was very common to see a property tax assessment $100 to $200 off per month. And there's been laws and regulations to make that more accurate to protect the consumer. But still, I'm consistently seeing it, especially as the year turns. I'll see it $20, $30 off. And that could be the difference for some people, Brie, of qualifying or not, right?
Absolutely. It doesn't sound like much, right?
It makes a difference.
It's a weekend of coffee, maybe.
Yeah.
But that $20 or $30, to some, it can put them from, if their loan product has a maximum 45% debt to income ratio, it could put them from 44.8 to 45.1. And, Houston, we have a problem. So that tax difference, we don't want problems. That tax difference can make an impact. And part of that too, of course, is homeowners insurance. Right?
Yeah, that's another.
Homeowners insurance is big, and so shop for that. Shop for that as quickly in the process as you possibly can. You've got to identify a property first and know the home, the address. But shop for your homeowners insurance, and we always say shop around. If you've got somebody who's great, I always say still get a few quotes, because you never know that particular year or cycle for the insurance company, what has cost them more, and maybe their rates are higher at that point.
Yeah, and that homeowner's insurance is always like disaster stuff that covers, like a tree falls on your house. It's mandatory. It needs, and you have to have it. It's a part of your estimated monthly payment and any prelim figures. But you come down to it, you actually are in the process of buying a home. You'll get to choose, and the variables are insurance credit score. There's actually a credit score for insurance. How many times have you switched companies? What company is it?
How many claims have you made?
How many claims have you made? Just like the safe driver discount. Or what deductible do you choose? Do you have a $5,000 deductible or a $100 deductible? So one of the things to know is it's always an estimator on those prelim figures from the mortgage advisor. And as we kind of book in the episode here, because this has been really good stuff, I want to make sure we cover a couple quick things. First and foremost, if you are considering to refinance or purchase, the MLO team, of course, it's Brie and I today, but we've got Casey, we have Christian, we have the full team of people here to support. How can they get a hold of us for that? No obligation, just reach out, safe call. What are some different ways they can get a hold of us, Brie?
They can call us on our VIP line. So it's 503-847-9038.
Yeah, and feel free to text or call direct. We are there. It hits us all on an app, so you could reach us, and we get all sorts of different calls, whether it's people in the industry or it's people considering to purchase, refinance. They might have a couple of scenario questions, and we absolutely love helping people. And the entire goal of the MLO show is to create a safe environment that's transparent, and you can learn and grow not only from the financial aspect and the mortgage, but real estate as a whole, right, Brie?
You can ask us anything. You know that we're part of the community. We're here to help, and we very much mean that.
Beautifully said from our mother of mortgages, Brie Fisher. I'm taking and closing out the episode with the fact that it's a human perspective. Start the conversation, regardless of what you're at. Get a team of people, such as someone from the MLO team or a trusted mortgage advisor who can look at your situation customized and objectively, because regardless of where you're at now, you want to start that conversation sooner than later. So until next time, you have been listening, watching the show MLO.
Thank you, everyone.
There it is, guys. We just took another step towards learning how to purchase that first home. Make sure you tune in next week as we uncover the 3 C's on getting pre-approved. And if you got any questions or comments, make sure you're calling us on that VIP line, and that phone number is 503-847-9038. We'll check you next week.